Welcome back. Earlier today, Federal Reserve released their interest rate decision, raising the Fed funds rate to the 5.25 level. That is the first time we've seen interest rates this high since 2007. Current U.S. Treasury sit as follows. The 2-month bond, the bill, pays a 5.33%. That is the highest yield across the spectrum. Just the other day, we were looking at 3-month bonds paying the highest yield, and then before that, the 4-month, and if we go back even further in time, the 6-month. What's happening is that we're seeing the highest yield move to the left, meaning from the 1-year, 6-month, 2-month. And what that's telling us is that the bond market in the near-term future is expecting these rates to persist. But in the long-term future, it's expecting lower rates. 5-year, the 7 years, 337, the 10 to 338. Now, as we get closer to the end of the interest rate tightening cycle, the higher yields move more to the short-term end, meaning to the left side of the chart. So if we were to visualize this chart over time, we'd see, like an ocean wave, it's the highest part of this is moving to the left. This is the 1-month change in bonds. We can see actually a little bit of a negative, actually about 0 on the 3-year. 5 years also at 0% change. The biggest change has been the 2-month moving up 10%. And again, this reinforces, the current trend, what we just said, that the highest yield is moving to the very short term, meaning that the market is expecting the highest yields to be only in the near-term future. This is what this month in bonds looks like. The black dotted line is a 1-month T-bill moving much, much higher from where it was just a couple weeks ago. The dotted purple line, that represents our 1-year, which is actually starting to soften a little bit, ironically. And then, of course, we have the red dotted line at the bottom. That's the 10-year. We're seeing an increase in the inverted bond yield spread. I saw earlier today the 10-1 spread reached levels, I think, of 135 basis points, somewhere along those lines. The black line, that represents a 10-year bond. The red line is the 1-year. The blue histogram bars pointing down shows the spread. We're currently sitting at a 1.32% spread. And the reason why that's important, we mentioned this the other day, is because if you go back to 2000 or the year 2007, the biggest spread we saw was 50 basis points. We're at 132 basis points right now. It's a very, very significant spread. It just means that the market is experiencing or expecting that much more of a divergence from where we are now as far as interest rates and where the economy potentially could be down the road. Here, the purple line represents the 10-year, the red is the 1-year, and the 1-month T-bill is the black line. Notice how this yield has just skyrocketed higher over time, and this also is set in front of the S&P 500, which are the gray histogram bars. And really what we're seeing here is just a widening between the 1 and 10-year bonds. Eventually, if history holds true, we'll see the 1-month bond, the T-bill, reverse back to the downside, and that would be an indication that the market has now come to the resolution. We're completely at the end of the tightening cycle, of the interest rate hiking cycle, and that the market also sees economic weakness on the forefront. Now, with that said, I thought it's also important to take a look at the equity markets. The blue line here represents the Dow Jones Industrial Average. Now, this is 2018, 2019. Just to give this some sort of reference, the black histogram bars with the area chart in the background, that shows us the spread. The spread of what? It's a comparison of 4 different stock market indices. The Dow Jones Industrial Average, which is the 30 largest stocks, McDonald's and Caterpillar, things like that. We have the S&P 500, which are the 500 largest stocks by market capitalization. That's much more of a widespread swath of, our economy. The Russell 2000, which are the small cap stocks, and then the NASDAQ, which is heavily weighted towards technology, things of that nature. Notice in particular, in 2018, the blue line, the Dow Jones Industrial Average, and all those indices were hitting their all-time highs. The black histogram bar on the background shows us a very low reading. What does this tell us? That the divergence, the difference between these different stock market indices was very, very small. All stocks were going up. And that's usually the case. When we have a strong bull market, all stocks benefit. The NASDAQ technology stocks, the S&P 500, the Dow large capitalization, giant capitalization stocks, they all go up. But notice what happened when the market started to show weakness. The blue line, the Dow goes down, and then the area chart in the background goes up. The spread increases. The spread is, again, the difference between the different indices. So we have, the small caps may go down or the technology stocks may go down. Every market, every economy has a different personality. But point being, when the market starts to weaken, some stocks weaken before others. Well, this is what we look at present day in terms of the equity markets. The red line, that represents the Dow Jones Industrial Average. The purple line is the S&P 500. The green line is the NASDAQ. All these indices are pretty close together. They were pretty strong, and now they're reversing the downside. The yellow line is a Russell 2000. Now, in the background here, these black histogram bars, that shows us the divergence between the two. Again, when the stock market is strong, the black histogram bars, the divergence, the spread is very, very low. Or conversely, when all stocks go down together, like they did in March of this year, well, then the divergence will be very low. It means when the spread is low, it means all stocks are agreeing to go up or to go down. But now we see a divergence which is occurring at a pretty significant rates. The stock market that was going up, all of a sudden the Russell 2000, well, not really all of a sudden, the Russell 2000 hit a low in March. It just has not found any kind of strength at all. There's no buyers out there for the small cap stocks. It really kind of makes sense when we consider what's happening with the smaller banking stocks as well. Investors out there do not have confidence in the smaller companies. They may want to hide their capital in Walmart and the larger giant cap companies. But even those found in the red line, the Dow Jones Industrial Average, those lately have not been faring well. But the reason we're mentioning this is because as the stock market was going up, the spread was moderate. The spread is now increasing. It means that one index, the Russell in this case, has really diverged. And logic dictates if one drops out, maybe others will follow soon. Now, finally, I want to talk about the mortgage spread because I think it's very appropriate given today's news. The mortgage spread, very simply, is a comparison of the 30-day average mortgage rates that we have versus the 10-year U.S. Treasury. Now, you may think, okay, well, the 30-year mortgage, that's like the 30-year bond, which it is, more or less. And so, why compare that to the 10-year? Well, there's more to it than that because a 30-year average mortgage is also a barometer on the housing markets and the level of confidence that the banks have in the economy and also in potential borrowers. Now, during recessions or times leading up to recession, the mortgage spread will widen. Again, what this shows us is the difference between the 10-year U.S. Treasury bond, which is a very good barometer of the U.S. economy, and the 30-year mortgage, which is the amount that the borrowers are asking for, if we want to take a mortgage, for example. Now, if the banks sense some sort of uncertainty out there, they want to build in a little bit of an extra insurance policy into their mortgage, they're going to ask for a little bit more in the mortgages. Even if interest rates go down, the mortgages won't go down very much at all. You ever wonder why, for example, let's say interest rates go down, but the mortgages still seem to stay very high? It's because the banks see extra risk out there. Well, the blue line at the top is a 30-year mortgage. The red line is a 10-year U.S. Treasury. The yellow histogram bars show us the spread, the mortgage spread. The 30-year mortgage minus the 10-year U.S. Treasury. Well, notice what happened. The spread was actually a little lower. It was around 2.67%. The difference between, again, 30-year mortgage and 10-year Treasury. Well, that has now risen to a level of 2.99. It's actually almost nearly the highest high we've seen in over a month now. So what this is showing us is that over the past 6 weeks, given current circumstances, the banks, the mortgage industry out there sees more risk out there than it has, in quite a while. Here we have the 30-year mortgage and the 10-year U.S. Treasury and the spread. The spread is a purple line in the background. This gives us a little bit more of a historical look. Now, notice how low the purple line was in 2017, 2018. We had mortgage spreads 2%, even below 2%. All of a sudden, we had that 2019, 2020 pandemic crisis. The stock market goes down a lot. Well, the U.S. Treasury, the 10-year bond went down a lot. The mortgages went down. But notice the Treasuries went down a lot faster. How do we know this? Because notice the purple line spiked up to a level. That's the mortgage spread. Now, ironically, it spiked up to a level of, well, it looks like a little under 3%. Or above that now. The mortgage market sees more of a risk now than it did at the height of the panic of late 2019, early 2020. In other words, we see even going back to 2013, these are more or less the highest mortgage spreads we've seen in nearly 10 years, probably actually a lot more if you go back further in time. Now, the red line is the S&P 500. The blue line is a mortgage spread, and we see an inverse correlation, actually a very, very close inverse correlation. When the red line, the stock market goes down, mortgage spreads go up. Mortgage spread is basically another way for us to measure the amount of fear out there. And it's a very interesting indicator because it's a level of fear that's established by the banks. We talk about the fear index like the VIX, the volatility index. Well, that measures the premium on the front month options on the S&P 500. Well, this is the fear index based on what the banks see, and the banks have a very good read on the economy. Now, finally, we see here, these are the average mortgage spreads by year on the left-hand side, 23, 22, all the way back to 2014, and then designated by month. 1 is January, 2 is February, so on and so forth. Well, currently, May, or at least what we have right now for May, we have a 294 average mortgage spread. I believe the average over the past 10 years is, maybe around 1.7 if I'm not mistaken. Well, the average for this year, 2023 right now is 279. That's the highest average we've seen in the past 10 years. The average last year was 2022, 235. 2021, that was a recovery. The mortgage spreads were down in the 150s. And then, of course, in 2020, that was an enormous amount of fear. That was at 223. So point being is that we have more fear and more uncertainty built into the mortgage spread dictated by the banks that we've seen in quite a long time. The reason why we mention all this, and let's go back to the 10-1 spread for just a moment. What we're seeing here is a widening between the red line, the 1-year bond, and the purple line, the 10-year bond. Ignore the black T-bill, the 1-month T-bill, for example, for a moment. Notice how this is widening. The 1 year's going up, the 10 years staying flat and kind of pointing down. This is showing us a real disagreement between what the bond market sees right now and what it sees for the long-term future. Right now, it sees higher interest rates. We got higher interest rates today. The Federal Reserve said, they're watching inflation carefully. They may raise rates again. But over the long term, the bond market is forecasting weaker economic conditions. We've seen this pattern in the past, 2000, 2007, where in the immediate future, we expect higher rates, long-term future, lower, weaker economic conditions. So it's a very important dynamic that we're seeing over here. The stock market is not going to react immediately. The stock market is actually usually very late to the game. Good news for us, if we want to take a position. But it's an occurrence that is not very common, and it's very, very interesting to watch right now. So we're going to keep a careful eye on this and many other indicators. Later on this week, we have much more numbers, and the jobs numbers are coming out as well. So that should certainly provide us with, a lot more data to talk about. We thank you for joining us. We hope it's been helpful. We look forward to seeing you back soon.